What do I look for when I want to buy gold? I want to see falling nominal and real interest rates. And I think the next move is disinflation and then deflation. And that's when gold just performs spectacularly. So that's the next catalyst that I'm looking for. In a deep liquidity crisis, everything gets sold. And that includes gold. That's not anywhere near the situation we have right now. The first move is a skyrocket. So when the economic data deteriorates later this year, gold is going to take off to the moon, in my opinion. The only thing you have to look at, which will be on my radar, is if we get into a repo crisis, when the money markets get clogged. That would be an occasion for me to sell some of my gold.
In a recent assessment by Michael Pento, president and founder of Pento Portfolio Strategies, the forecast for gold prices to potentially soar has come into sharp focus. Despite recent periods of inflationary pressure, Pento anticipates that disinflation and deflationary economic movements could soon favor the precious metal, sending its value to remarkable heights. This anticipation aligns with the broader market trends, as gold and silver prices have already started to climb, buoyed by an influential U.S. inflation report that, while slightly below expectations, has lent credence to Pento's outlook. Notably, the recent U.S. personal income and spending report supports a policy direction preferred by monetary policy doves, who advocate for sooner rather than later interest rate cuts by the Federal Reserve. Pento is no stranger to the complexities of gold investment, noting a potential challenge in the form of a liquidity crisis, wherein even traditionally stable assets like gold might face significant sell-offs. A prime example of such liquidity-driven volatility is the aftermath of Lehman Brothers' collapse, where gold initially surged amidst market fears, but saw a rapid decline as investors sought immediate liquidity, even selling off their gold holdings. Further, Pento underscores the fragility of the current economic climate, particularly in sectors like commercial mortgage-backed securities and commercial real estate, which have been grappling with significant challenges. Approximately $1.5 trillion of U.S. commercial real estate debt is set to mature by the end of 2025, posing significant repayment challenges. Office landlords, in particular, are feeling the squeeze due to rising borrowing costs, plummeting property prices, and credit tightening from banks and non-bank lenders, all amplifying uncertainty in the wake of the pandemic-driven shift to hybrid work models. Join us as we explore the insights shared by Michael Pento. Stay updated by subscribing to our channel and activating notifications. Thank you.
I have no silver. I know it disappoints a lot of people, but silver is a base metal and a precious metal. And unfortunately, it's probably the most manipulated and most frustrating market I've been in this business 33 years, Jesse. I find silver extremely frustrating to even try to invest in. So I have none of it right now. Again, silver might be one of the major holdings in the next reliquification of the banking system cycle that we're going to go through late in 24 and 25. But right now I hold about 7-8% of the portfolio in physical gold, and I'm very happy to be there. And the catalyst for that is just, we have this country's got such a situation, tenuous asset bubbles that are breaking, though it's being masked by the mainstream financial media. They don't talk about it much, but commercial mortgage-backed securities, commercial real estate properties are in a devastating condition. In fact, if you look at the home price to income ratio, it's higher today than it was even at the peak of 2006 in the previous lead up to the global financial crisis and the collapse of the housing market. It was 5 back then. Now it's 5.5. So we've never been in a worse situation. And home prices are today 50% more expensive to own a home, 50% more expensive than it is to rent. It's never been anywhere close to that. So this situation in this country is very tenuous, and that lends itself to like, what do I look for when I want to buy gold? I want to see falling nominal and real interest rates. And I think the next move is disinflation and then deflation. And that's when gold just performs spectacularly. So that's the next catalyst that I'm looking for. Again, with one caveat, with one quick caveat there. In a deep liquidity crisis, everything gets sold, and that includes gold. So that's not anywhere near the situation we have right now. The first move is a skyrocket. So when the economic data deteriorates later this year, gold is going to take off to the moon, in my opinion. The only thing you have to look at, which will be on my radar, is if we get into a repo crisis, when the money markets get clogged. That would be an occasion for me to sell some of my gold, but it wouldn't be something I would sell for a very long time because I know what's going to happen on the other side of that. So,
And any insight you could provide into how you evaluate gold mining stocks?
yeah, I have. So Jesse, like I said in the beginning of this program, I'm not a commodities expert and I'm not an expert in individual stocks. So, you look at Newmont, Barrick, just buy the GDX. You're probably better off just buying the GDXJ or GDX. Don't buy the GDXJ unless we're really in a really big, strong bull market for not only gold, but the miners, because GDXJ, which is the juniors, that will shorten your lifespan if you don't have that. So, yeah, that's why I try not to be a stop clock here, and I'm not a stop clock. I look at many, many factors all day, every day. And, people who say, well, just buy gold mining stocks. Well, yeah, that's a great idea, but there are times when you want to be out and short of them. And there are times you want to be, heavily concentrated in them. And so getting the timing right is what I try to do.
Pento's cautious outlook regarding the current economic situation parallels the 2008 financial crisis and raises concerns about the potential for similar or even worse outcomes. The 2008 crisis, widely regarded as the most severe economic downturn since the Great Depression, was preceded by the Federal Reserve's tightening monetary policy, including interest rate hikes aimed at controlling inflation. However, this move inadvertently slowed the flow of credit into the real estate sector and led to a significant rise in mortgage rates, catching many borrowers off guard. In the face of a deteriorating economic landscape, Pento acknowledges the possibility of the Federal Reserve adopting a strategy similar to the one employed during the last crisis, which involved reducing interest rates to near zero levels and implementing quantitative easing measures. However, he raises concerns about the potential negative consequences of such actions on the nation's debt levels, the sovereign bond market, and the value of the US dollar. The Federal Reserve's recent decision to forecast 3 interest rate cuts without specifying the timing of their implementation has sparked speculation in the financial markets. The central bank's decision hinges on whether inflation, which has decreased significantly since its multi-decade peak in 2022, continues approaching the Fed's long-term target of 2%. Let's get back to the interview.
So I'm cautious on mining stocks right now. I only have a very small stake in gold miners. Miners are much better run companies, but they're still stocks. Gold mining stocks aren't gold, and they are stocks. So when the stock market is in trouble, these miners tend to get killed. If you look back in 2008, the miners topped out in the late spring, in the spring of 2008. And then by the time July and August came, the liquidity crisis became particularly salient, and these miners got wiped out because the whole stock market got wiped out. Then they bottomed earlier. They bottomed earlier in the stock market because you want to own miners when the liquidity is pouring into the system. And we just talked about this. In the response to, and I think, yes, I do think we could be headed for another 2008 scenario. It could even be worse than 2008 because, yes, we have massive bubbles out there. We have the bubbles in real estate. We had the bubbles in fixed income. We have an unprecedented bubble in the stock market. So it could be worse than 2008. But in 2008, the Fed, within a year, Bernanke lowered the Fed funds rate from 5.25 to 0. Didn't even blink. Will Powell be able to do that this time? I just don't see it happening that quickly because we know where this road ends. I mean, you could have a stagflationary quagmire in this country like we've never seen before. And that's when you want to own commodities. Let's just suppose Powell is, there's a good case because the Fed exists for what reason, Jesse? They exist to protect the lower and middle classes of the United States citizen? No, they're in existence to protect banks. That's what they're there for. And they'll say, well, if banks don't function well, then that the consumers are finished. And so that's why we have to do what we have to do. But that's not their rationale. That is not their primary target audience. That's not their goal. Their goal is to be the bank for banks, the banker for banks. That's what they're there for. So they could return to ZERP and QE, and maybe Janet Yellen and Powell will launch helicopter money part 2. But the devastating effects of that for this nation's debt to GDP ratio, for the sovereign bond market, for the dollar, and you want to own commodity, you're gonna want to own commodities in a big way if that's the case. I expect oil, uranium, and gold. Those are the 3 things. And I would even venture into some of the soft commodities too, because in stagflation, they do fantastic. That's what the back test shows me. So those are all things I'm interested in. We are headed into first, I think, we've been in disinflation. We have a small cycle here of inflation. I don't think that lasts long because we just talked about that liquidity cycle that we're headed into starting in March, April. That goes from disinflation then to deflation and recession. That's when you want to short commodities. Then coming out of that, as the Fed with reticence and reluctance goes back into reliquifying the banking system, that's when you want to go. That's the nucleus of my portfolio will be commodities.
The recent U.S. inflation report has been cited as a catalyst for gold prices, but there's been a divergence in market sentiment between gold bulls and bears. How do you reconcile these conflicting views, and how do you see this playing out shortly? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.